Welcome back to the channel, everyone. I am officially back from week-long vacation, feeling refreshed and ready to get right back into our weekly routine. We have a lot to talk about today because the stock market got pretty bumpy. If you've looked at your accounts lately, you probably noticed that big tech and those massive AI stocks finally ran out of steam and took a big breather. People are starting to worry about how expensive all this AI stuff is to build, and that dragged the tech-heavy Nasdaq down over 4% this week, while the S&P 500 dropped nearly 2%. But here's the interesting part. While tech was bleeding, a lot of money started moving directly into safer, steady areas like healthcare and real estate. In fact, the Dow Jones actually hit a brand new record high this week because investors are rotating their cash out of overhyped tech and putting it into solid, dividend-paying companies. On top of that, the latest inflation numbers just came out and things are still looking pretty sticky. Because inflation isn't dropping as fast as people hoped, there's a lot of talk now that the Federal Reserve might raise interest rates again later this year. When interest rates are high and tech starts sliding, this is exactly why we build a diversified, income-focused portfolio. When growth stocks stumble, steady cash flow is still doing its job. So, let's jump right over to the dashboard, look at how my holdings held up through all this madness, and break down our numbers for the week. Before we talk about the performance numbers, I want to give an update about my previous attempts on the portfolio transfer. If you look right here at my history log, you'll see a whole string of failed account transfer notices. I was attempting to move my holdings over to Robinhood to take advantage of their 2% transfer promotion. But after 6 separate rejections over small administrative mismatches and the promotion period has ended, I've decided to just give up on the transfer. I'll just take it as a sign that I might not need to transfer it at all. Plus, keeping this portfolio right here on M1 means my passive income stream remains completely uninterrupted, and I can keep better track of my incoming dividend cash and easily put it exactly where it needs to go when it comes in. So now that we got that out of the way, let's pull up the dashboard right here and look at how the individual slices of our portfolio actually weathered this tech storm. Like I said earlier, M1's standard 7-day filter makes it look like we dropped nearly $11,000, but that is because it's dragging in previous market noise. When we look at the actual trading week from Monday morning to Friday close, our total balance went from $238,431 down to where we sit right now at $232,234.18. That is a real weekly drop of about $6,197, or roughly 2.6%. And if you want to see proof of why a diversified strategy matters, just look down at the individual slices under my main portfolio. The tech sell-off definitely hit our heavy growth names. Palantir dropped over 12% this week, NVIDIA was down over 8.6%, and Apple and the QQQ both slid over 4%. When you have big positions like Palantir sitting at over $58,000, a 12% drop looks like a big red number on paper. But look at the very top slice on the list, our Dividend Pie, which holds $72,245 of our capital. While tech was getting absolutely crushed, the Dividend Pie bucked the trend entirely and finished the week up 0.52%, adding $377 in green gains. Growth is going to have its volatile weeks, but having that massive $72,000 dividend cushion holding the line is exactly what keeps our portfolio steady when the rest of the tech-heavy market starts sliding. And while the stock prices fluctuated, the dividend engine didn't skip a beat. If we look at the activity ledger from this week, we had a massive wave of payouts hit the account while I was out sunbathing in the Caribbean. I want to read through these individually to show you exactly how these positions chipped in. June 22nd, QQQY started the week off strong with 2 payouts of $6.60 and $4.18. Manulife Financial, MFC, also delivered a core payout of $8.73, alongside a tiny standard foreign tax adjustment of minus $1.31. June 23rd, BlackRock, BLK, paid $4.32, and Vanguard's VEA sent over $6.78. June 25th, Qualcomm, QCOM, chipped in $5.13, and the YieldMax Magnificent 7 Fund, YMAG, dropped two massive distributions of $14.89 and $27.59. June 26th. To close out Friday, QQQY hit us again with $4.50 and $6.01. We got $4.98 from Bank of America, BAC, a great $21.03 from NVIDIA, NVDA, $4.58 from Lockheed Martin, LMT, $7.92 from Principal Financial, PFG, and a solid $20.26 from Round Hill's QDTE. When you add all of those up, it brings us to a grand total of $146.19 in pure passive income in just 5 days. That cash goes right back into the engine to keep the snowball growing. At the end of the day, weeks like this are just a normal part of the journey. Markets go up, markets go down. But seeing that $72,000 dividend pie hold the line is exactly why we build our portfolios this way. It lets you sleep a little easier at night when the market volatility gets bumpy, because it is all about tuning out the daily noise and focusing on the long-term cash flow. Before you take off, drop a comment down below and let me know how your portfolio handled the volatility this week. Are you holding steady? Or are you using this tech drop to buy up some shares at a discount? Let me know your game plan. I really appreciate you spending a few minutes of your day here with me. Have a great rest of your week. Keep your head up, keep compounding that wealth, and I'll catch you on the next update. Take care.